All right, guys. Hey, thanks so much for participating in my curiosity question, which was what is the net worth difference between a homeowner and a renter? And this came off of a call that we had. We were kind of taking a look at some different metrics, and this particular slide I'm about to show you kind of stood out. So I wanted to share it with you. I thought it was really eye-opening. Here are the results to the question that we asked. So the homeowners, the average homeowner net worth across the United States. So this isn't coastal. This isn't just California, Los Angeles County, et cetera. This is just across the United States as a homeowner be 396,200, and then renters 10,004. Now the difference, just in the event that you don't know what the net worth calculation is, it's really you're going to take your assets, you're going to back out your liabilities. It's whatever's left over, right? So you could have an IRA, 401k, you could have savings accounts, etc., and then you could subtract out what you owe on your car, what you owe for your student loans, your credit cards, and personal loans, etc. That's going to leave you with your net worth. So in the scenario here with the renters, they just don't have home ownership, right? They don't have any equity in a house. They just pay their rent. And so their assets versus their liabilities, the average is 10,400 is left over in their favor. So net worth positive, but only at 10,400. Net worth positive 396,200 for a homeowner. The big swing in this being their home's equity. This isn't. We have to kind of take an assumption here. It's not all home equity, but it's a good chunk of it. Sometimes being a homeowner also creates some responsibilities and awareness around other liabilities. Maybe don't take on or stretch yourself as much. And so that could yield to some of the gain that we're seeing right here. So I don't want to say this is all home ownership or equity, but it basically is the difference between somebody who has a home versus somebody who doesn't. I'll share a couple other slides I thought were kind of fun. And this was from another study that we were doing. I thought I would just throw it in here just to kind of share with you, since I've got a captive audience here with you guys. So consumer debt. This is just credit cards. Right here, we are at a little over $1 trillion right here, and our savings accounts are almost at a decade low. The run up right here that you can see, so this green chart is the savings. We had this big, huge spike. This is right when COVID and coronavirus and all that stuff was kind of coming out. And then we got locked up. We couldn't do anything. And we had stimulus money coming in. And all of a sudden now our savings rate just went through the roof, and our debt, our consumer spending, our credit cards went down. We actually maybe used some of the money. We were paying down credit cards. We weren't going to amusement parks. We weren't going to the movies. We weren't spending as much, on stuff we don't need. And so our credit card liabilities were going down. You can actually see that right here. And then right after Q1 of 2020, or I'm sorry, 2021, it started to go up, and it went up pretty steep. And so now we're at these record highs for credit cards. So this is an area right here, whether you're a homeowner or not, this is an area of concern right here. Now, if you are not a homeowner, if you're a renter, you got a couple choices. You got to just buckle down and pay that credit card debt. If you're a homeowner and you've got a ton of equity, you can consolidate, and you can use some of your home's equity for good to kind of chunk away and knock, whatever your portion of this 1.5 or $1.05 trillion is. You can use your home's equity to kind of help get you out of that, right? Where a tenant doesn't have that. Maybe they can dip into their savings or even retirement to kind of chunk away or get rid of some of the credit card debt, but they just don't have that home's equity. So this will be really interesting to see what happens. I actually think that at some point in the near future, we'll see probably a record or study that shows like a record number of bankruptcies, because I think people are definitely overextended. We see it every day on credit. We pull credit. The amount of car loans, or actually the level of car loans, are really, really high. And then the credit card debt is incredibly high right now. If you're a homeowner and you are running into a situation like that, here's a cool little chart right here that brings some awareness. So this green pie, 38.7% of Americans actually own their home free and clear. They actually do not have a loan at all. So, that's almost getting to 40% of these houses that are out in the world are owned free and clear. Pretty wild. And then the chart right here, 31, has less than 50% equity, and then 30% have at least 50% equity or greater. So they still have a loan, but they have at least 50% equity position, which is pretty strong. This next little chart, which is kind of fun, is showing you how much tappable equity is out there in the world. So we hear a lot of times people say, I don't know how people are paying for this stuff, or I don't know how somebody's able to buy another house, or how is this person able to buy, 4 rental properties or any of that stuff. It's because there's an absolute ton of tappable equity, right? We back to that chart showing that 38% own their house free and clear. So if this person wanted to scale, they could easily pull a loan against the property and then go buy another rental property, right? Or buy 2 or 3 rental properties if they were smart. This person's got 50% equity, so they have a ton of tappable equity they can tap into, and they can do the same thing, go buy some rental properties, invest, open up their own business, buy a business. You get creative with it. There's $9.3 trillion worth of money that's out there. And so this is, again, also only based on 80% of the home's value. I thought that was interesting because a lot of the loans are capped. You can't really pull more than 80%. You can do it with equity lines. You can do it with like VA loans, and a couple other loans will let you go a little deeper, but most of the traditional conventional loans are only going to let you take 80%. So this chart, this 9.3 trillion of tappable equity, is talking about taking you to that 80% loan to value. And then finally, a couple of ways you can use your home's equity. I thought this was just some good awareness for people. Consolidate debt. We see a lot of inquiry on this. This is one area that I'm going to try to just drive home, maybe on a daily basis. We get these people that are trying to consolidate debt way, way, way too late. Unfortunately, we hear from them after they've already used all their credit cards or after they've gone late on credit cards. And at that point, you start to trash the credit, maybe because your use is too high, your limits, you've kind of borrowed everything on your credit card, or you got some late payments and now your credit's kind of taking a big deep dive and you can't get the financing. I cannot express it enough. Like, if you feel like you're kind of generally going that direction, you need to actually talk to a lender about using your home's equity sooner than later. And remember that the tenants don't have the ability to really consolidate debt other than calling the debt consolidation companies and put it all in one place, which is way more expensive, also more risky than using your home's equity. In fact, in many cases, those debt consolidations can still hurt your credit too. So be careful with that. And then we all are sitting on, or most of us are sitting on, incredibly low interest rates. So these home renovations are usually just either self-funded by the extra savings that we have, or we're using home equity for that. Like, we're using like a HELOC or a home equity loan because we don't want to touch our really low interest rate first mortgage. We don't want to redo that to stay there. And it's too expensive for us to sell our house and move into something else. So use a home equity loan for home renovation. School tuition, this is kind of like lower on the list for us. We usually don't see too much of it, but it does make sense as people are starting to head off to college. Instead of having the college student loan, maybe use the home equity. Although it would have been a good idea a few years ago to take out the student loans and then get that debt forgiveness that nobody really saw coming. So I guess you would have won there. The one I would probably, if I was to build this slide, I'd rearrange this as I'd buy that second home. I'd rephrase that as to buy an investment property, and I would show that one up like probably closer to here. So first, consolidate debt. Second option, in my opinion, get investment property, use your home's equity. Remember, your home equity just sits there. It doesn't do anything. It looks good on paper, but it really doesn't help you unless you actually use it. So anyways, this was kind of fun to share with you guys. Thanks so much for your participation. And if you like this, let me know. I'll kind of build out a few other fun things for you to check out in the future. All right, guys, talk to you in a bit.